If you're retired or considering retirement in the next couple of years, then you should be aware of the current share market and property market, which are both at all-time highs and showing signs of being overheated. This is particularly important as sequencing risk can destroy your superannuation and other investments and your retirement lifestyle plans. We're going to explain this and show you some of the ways in which you can effectively manage this risk to protect your wealth and your financial well-being without unnecessarily sacrificing good investment returns. Sequencing risk refers to the order in which good and bad investment returns occur, the size of these good and bad returns, and how these investment returns affect your portfolio balance. To explain this, let's assume that you plan to keep working for say 15 years. Now, let's also assume that your portfolio, which we call Portfolio A, delivers the following investment returns that vary from year to year, with both good returns and loss-making years. Now, let's assume there is an alternative portfolio that you could invest in, and we'll call this portfolio product B. This portfolio delivers exactly the same returns as portfolio A, but in the reverse order. Now, despite the investment returns occurring in the opposite order, both portfolios actually deliver the same average return over the 15-year period. This sees both portfolios produce exactly the same ending balance at the time of your retirement. So the order of good and bad investment returns doesn't really matter if you're continuing to work and are going to remain in the accumulation stage of investing. In short, yes. Let's again look at your two portfolios, but let's assume that you're going to retire from work and that you decide to draw, say, $60,000 per annum from your portfolio to help fund your retirement lifestyle. For your portfolio A, the combination of regular withdrawals and the series of negative investment returns in the first few years means that you have less time to recover from the losses you made in the first few years. This sees you run out of money after 13 years, while portfolio B still has you with a portfolio balance of around $1 million at the same time. So you can see how sequencing risk, or the order in which investment returns occur, can significantly affect your personal wealth and lifestyle plans. If the property market, the share market, or other investments struggle or significantly fall in value over the next few years as you are approaching retirement, or if you're already in retirement, then this could have undesired consequences. For example, you could be forced to compromise your retirement lifestyle and spend less. You may need to delay your retirement and keep working. Or if you're already retired, you may be forced to return back to work in some capacity. Fortunately, there are. They include taking a systematic asset allocation approach to investing. This may see you choose, say, having a greater exposure to growth assets, share and property style assets in the earlier years while you're working, and then reinvesting the earnings in more defensive assets as you approach your retirement years. You could consider using a bucket approach. This generally includes putting aside 1 or 2 years worth of cash for your upcoming planned expenses into a separate bucket or separate account to avoid drawing down on capital while the markets happen to be down. You could use a systematical rebalancing approach. This includes regularly taking profit from better performing growth assets and investing these funds into other possibly more defensive assets, ensuring that the asset mix remains in check with your risk profile. You could take a more flexible approach to withdrawal rates in retirement. And finally, you could invest via a platform or superannuation fund that allows you to diversify your investments across different asset classes and critically provides you with the flexibility to choose which assets to draw upon in retirement, rather than investing in a one-size-fits-all balanced fund type structure. Importantly, the right strategy or combination of strategies will depend upon your personal situation. So I recommend that you seek specialist advice from an independent financial advisor. This is particularly important as the property market and the share market and other investment markets at this time are at all-time highs and showing signs of being overheated with all the various government stimulus. This is likely to see you experience increased volatility in your portfolio balance, especially as there is significant uncertainty about economic environment both here in Australia and around the world. If you would like to know more about managing sequencing risk in your superannuation or other investments so that you can better protect your wealth and retirement lifestyle plans, then please talk to us. Insight Private Wealth is an independent financial advisory firm. We're not owned or controlled by the banks, industry super funds, or any other large institution. And we don't accept investment commissions. This ensures that you'll receive professional and independent financial, investment, and retirement lifestyle planning advice that's in your best interest. So for trusted superannuation investment, retirement, and financial planning advice, contact us via phone on 8211 0505 or through our website at insightprivatewealth.com.au. We'd be glad to help.